Okay, very good morning. Tuesday, the 26th of September. Quite a few things to discuss this morning. And so, going to get straight to business. Let's have a look and recap what happened really yesterday. And I guess yesterday there was two significant things that occurred. This was the result of the German election, as we know now. Wasn't a particularly big move in the market, did cause some slight risk-off sentiment, i.e. the euro did pretty much continue its downward trend that we saw in the morning throughout much of the day, and actually this is a fresh month low that we're printing in euro-dollar pair this morning. You can see, looking at this chart, the biggest move here, I mean you've got to put this into context. I did see an interesting comment by someone yesterday saying that, if you look at these two moves, there's this one here that I've just got in a rectangle, and then really this is the gap low on the German election. Well, there's two very powerful women at play here, and if you were arguing who's the more that the market's watching at the moment, well, this was Janet Yellen, of course, with the hawkish Fed. The fact that they continue to pursue this quantitative tightening commencing in a couple of days' time, actually, beginning of October, and then also the interest rate hike in December, which is now priced into the market. But then this was the gap low that we had on the German election. And granted, we did continue to grind lower throughout the rest of the session to where we are at the moment, a sub 119 handle. It's just quite interesting to see, though, as much as the press, the media are putting on this German election, talking about this far-right nationalist party, of which I've read this morning are already at loggerheads on how the AfD should act going forward. We talked about this yesterday briefly, about the more moderate and then the more extremist right views that they have even within their internal party was going to be probably the barrier to them really making much progression, and that's already after 24 hours appeared to have been the case. But you can see here really the decisions of the Fed are so important for the market and will continue to be so going forward. But the movement of Janet Yellen really was the big one. But here we are back down a 1 month low then for euro dollar, and certainly this should give the ECB a little bit of breathing room from the slight panic that we had only a few weeks ago when we were up testing 121.50 on the way to 122 in the euro dollar pair, which when you start looking a lot more longer dated, you've got to go back a considerable period of time before you get to that last price point of 121. You're looking at really the end of December of 2014. So to put it into some context of how elevated the euro really has been. But the other big thing that obviously occurred yesterday was this chap. This is the foreign minister in North Korea, and North Korea accused Donald Trump of declaring war on the country and warned that Pyongyang might shoot down US warplanes flying around the Korean peninsula. I think the comment they said was that a US bomber doesn't even have to be flying in their airspace and they will shoot it down. So obviously this is the new level of escalation, if you like, in the rhetoric regarding the Korean peninsula, and this did spark a risk-off move across the board. We saw equities at that point in time dip. Fixed income futures rallied, as did the Japanese yen and gold. So it was kind of your classic flight to quality move. And looking at gold here was probably the most defined move. Just looking on my chart here to the actual move that we had. But there was a trade which Philippe here on the floor took, which I guess kind of wraps up the way that the move occurred. And just talking through his trade here, he's quite good for me. He's marked it up and he's refreshed my memory of exactly how he executed this. So the news started to break, and as you can see, we were kind of in a fairly tight price pattern. You can see on the 1 minute candlesticks until the actual news came out. The foreign minister was expected to speak, so there were quite a few people kind of geared up waiting for that commentary. I actually believe at the time Philippe was off his desk, so obviously he missed the initial move higher, but there's a significant technical point on the daily pivots. So the price jumping from basically S1 up to pivot on the back of the first comments. The foreign minister then continued to speak. He's then gone in with 2 contracts at the pivot level when you can see it got to that 129.96, pulled back down, and then he's gone long. On the break of that level on the 1300, you can see there when we break 1300, likelihood some stops just above the figure, seeing an extension of price action in quite a quick fashion. So immediately he takes one off. But then when it comes back down to, again, if I was to plot a line on that 113 handle, you can see he re-enters the market and adds another one. So again, booking one of the contracts pretty quickly on the spike higher. That would have happened just a matter of seconds. Comes back to 1300, so looks to re-enter another contract on a classic. You then get another big push, takes another one off just above that previous high, and then booked a profit at the high of Friday. He then continues then to keep one on the premise that overall this is escalation enough in the commentary that we're going to get a continued risk-off trade on the back of this. So again, it's come out of the position, but to keep one on to the eventual target, which is R1, of which then he comes out of that final trade. So again, taking the price from just below, well, pivot sub the $1,300 level, and then coming out, well, probably about $5 above there. Now, interesting to see that actually gold did continue to go quite substantially higher than that over the course of a period of about half an hour or so. You can see here the move, not only did it go to, so this was the actual move in which Philippe traded, was here, but you can see the benefit of having multiple contracts, that you would apply the same principle that he did there, scaling out of some of the position at technically significant levels. So at 1300, you can see this is a 15-minute candlestick, but that was when, again, he re-entered with another contract, took it higher off some of the, took a contract off at the high of Friday, which would have been around these levels here. But then after R1, again, you could have remained in that and scaling out R2 and then above. Interesting here then, the gold this morning, after that initial reaction that we had, which was about a 20-minute move late yesterday afternoon, the high point you can see on the extension of that wick was 1310 spot 3, and that's pretty much acted then as support point this morning as we look back on those levels from yesterday. So that level there, and then that's where we've printed this morning. So interesting to see that the market's kind of used that again as to keep prices elevated, because gold this morning is pretty flat, but net it has held on to the bulk of that gain that was seen on that North Korean development. Although equities recovered, now this is what makes equities a bit of a tricky one to trade over this type of information, because gold is a little bit more cleaner, if you like, a straight kind of sentiment play on risk appetite, whereas with equities the initial reaction is a little bit different. The initial reaction is one of negativity, and equity markets move substantially lower, but then ultimately if North Korea was to escalate to the point of military level, let's say, well then certainly a Fed's not going to be able to hike and execute its tightening, and equities actually managed to recover late in the game, whereas gold holds on to the bid, as too did fixed income futures. So that was probably the biggest move from yesterday. A quick look elsewhere. There's a couple of other things that I want to talk about this morning, and oil is definitely one of those. And I'm just looking at here, this was WTI crude yesterday. A huge rise that we had in prices, really from the point of when the US stepped into the market. We, on the day, went from around 50.5 all the way up to 52.5. A $2 move. By no means is that the biggest move I've ever seen, but certainly a pretty decent comparative to, you can see this very tight range that we were in towards the back end of last week. Where does that put us long term? Well, we already got above this. This is a daily continuation chart now, that 50.43 level, which defined the kind of summer high, talking late July here. And then you can see 51, there's not a great deal there in historical price action other than the psychological handle. So when we broke that yesterday, it went through it pretty quick, up to 52, which, as you can see here, was that high that we printed back in May. You can see on prior occasions that 52 has been a relatively good level. And this morning we broke above it. We're just trading around there at the moment, about 5 cents below the figure. So where do we go from here if we continue to go on the upside? The most obvious target would be that peak that was seen back in what would have been mid-April, 53.46. Any movement beyond there, then we start looking at really the psychological level of 55, which has been really the upper bound of crude oil prices for some time. As we know, if the price of oil gets too high, what does this mean? Well, it gives then particularly North American producers more ability to be able to ramp up production once again, granted, albeit if there is sufficient demand there. Now, talking about oil, there's a couple of things here to quickly review. One is Brent. So most simply, if you're looking at the two major crude contracts, you have Brent and you have WTI. One which is kind of the, I guess, the global benchmark, which is Brent, and WTI, which is West Texas Intermediate, so North American. But Brent, the move yesterday in WTI was largely in sympathy with a very large pop that we had in Brent futures. And that's because they hit a fresh 2-year high yesterday. Why was that? Well, this was the main headline. Turkey says it could halt Kurdish pipe amid independence vote. That was the main fundamental catalyst. And then a lot of people talking about, from a technical point of view, this is Brent's 50-day moving average crossing above the 200-day. So this would be technically known as the golden cross. And as you can see, with crude futures in Brent moving up to levels around 57, we've managed to get above the high points that were seen towards the back end of last year, earlier this year, beginning of 2017, causing then the blue line, which if you only go back about 2 months ago, there was quite a big divergence between the two, but they've converged over really the last 4 or 5 weeks to the point now that the blue, the 50-day, is above the 200, which some would say would be a bullish signal. Commentary-wise, what are the banks saying about this? Well, actually, there's quite an interesting note out of analysts at Citi this morning. And they're suggesting that you should get ready for an oil squeeze. And basically their argument here is that 5 countries in OPEC, Libya, Nigeria, Venezuela, Iran and Iraq. Now the two are very influential, of course, because they are two that comprise of the top 3 producers within OPEC. Iran and Iraq roughly combined account for about 9 million barrels per day of crude. Cities say they may already be pumping at their maximum capacity this year. So rather than a surge in output, there's a risk of a market squeeze emerging as early as 2018, driven by those nations because of weaker investment in exploration and development. So basically they're at their peak, they're not investing in further development of oil wells and sites, facilities and infrastructure, and therefore you can't really expect them to be able to go any further than the point of which they're at the moment. So net, if they're going to be an oversupply, well, Citi would say possibly not. Fear in the market has been that OPEC production will rise dramatically. However, they say there could be a supply gap emerging which could point to a tighter market. And obviously this would be which would lead to then prices being supported at that point. Let's not forget as well that global economic growth, at least at this point in time, is forecast to continue to improve. A few other things to also contemplate with the oil trade, and we're starting to look a little bit, I guess, medium long term here. But this has been very interesting, and this is something which I know for some of the guys in the second stage at the moment, we looked at this chart at the time. Well, this is the latest update. This is the OPEC compliance levels. And what's interesting here is the bottom half of this chart. That is the non-OPEC nations compliance level. And we talked about this before. The Russians at the beginning of this OPEC non-OPEC deal back last year were highly non-compliant. It was almost that they felt well, Saudi, it's up to you. You need to shoulder the burden for everyone else. And so why should we really do too much? Because we obviously want to generate revenue on the back of sales of crude oil. But what's happened now is that compliance from non-OPEC nations has jumped hugely over the period of the last month. When I talk month, I'm talking August comparative to July. We've gone from 69% to 119%. So when we hear about comments from the Russian Energy Minister Novak talking about we should seriously be contemplating about an extension to oil deals, well, actually, you scratch beneath the surface, there is some validity to what he's suggesting. This isn't just verbal intervention to try and prop the price. It is that, but it's coupled with a much higher level of compliance. And then if you look at the OPEC nations, after we had this kind of March, April, May period of very high compliance, we dropped off in June and July, but we've steadily started to come back towards target. So if you look at OPEC as a whole, if you join the 94 with the 119, then we are compliant at this point in time. So again, those fears that we had back when this initial deal was struck at the end of 2016 about whether OPEC and non-OPEC could remain compliant, well, this is being answered because they are at this point. And again, that would be another supportive factor. Just to give you a bit of an idea about how compliant these nations are being, well, as we've already known from the start, Saudi have been over and above the mark, if you like, cutting more than actually is part of their pledge in the OPEC agreement. Venezuela, Kuwait, Angola, Qatar, Gabon, all doing so. Iraq, we know, has been the worst offender within the cartel, given the fact that they've said that basically because of terrorism within the country that's dramatically impacted their fiscal situations, and they have the right to be non-compliant. It's kind of the summary of that situation, why they're so uncompliant. On the flip side, though, the one that's drastically changed here, because I remember only a few months ago, this was about half full as a square. That is now Russia are over and above the amount that they are required to cut as part of the agreement. So they're doing even more than is necessary by about 19,000. Mexico stepping it up, Azerbaijan, Kazakhstan, you go down, but these are relatively insignificant, these other smaller producing nations when it comes to Russia, which is the key. Because if you look at Russia, they're over compliant by 19,000. That's pretty much Bahrain, Sudan, South Sudan, all combined, just in that figure alone. So you can see the bigger boys stepping up, backing the smaller partners. This is something interesting to contemplate as well for the long term in terms of what's the future for OPEC. Where do we go from here? What I'm looking at in particular is you can see the over-compliant, the ones who are cutting, and the ones who actually are increasing production. Now we know that 3 of these countries are actually exempt. Iran, that was conditional as part of the compromise that the Saudis made, bringing Iran to the table. So we know that their production was going up. Libya and Nigeria, though, they've been 2 of the key countries that have really been to the detriment of this deal having even more of an impact on the market. That's because we know that they got exemptions on the fact of their civil situations. And the current readings would suggest that they are pumping some 300,000 more than they were previously. If you start to look at what is that in a percentage change, well, don't forget this deal at the end of last year in 2016. If we start looking at where we were to where we are now, Libya has had a percentage change in their production of 55.1%. Nigeria, 20%. This, I don't know if you can quite see these grey lines here, this is everyone else. So basically everyone's being compliant, so a reduction. However, these 2 are the main culprits, and this is them where at some point or another you would think that in the coming months the OPEC deal needs to change. And actually probably at the next official meeting it wouldn't be surprised to see that the conclusion would be, okay, Libya, that's fine, you've increased this amount, however you shall increase no more, and you too should be subject to a cap The same case probably for Nigeria. So it just makes a bit more sense of how outlying that these nations have been, having had that luxury of an exemption. So a couple of things here, and you can see on the argument on the balance, when you look at some of the technicals like we've seen in Brent, what some of the investment banks like Citi are saying, and then some of the compliance levels, might start to make a bit more sense of why oil has been in such a bullish mood. Okay, a few other things just quickly I wanted to talk about, because if you were monitoring the US stock market yesterday, you'll notice a significant underperformance in the Nasdaq 100. Now the S&P and the Dow finished down about 0.25%, but the Nasdaq finished down 1.1%. So a significant underperformance within the tech sector, which dragged on the US equity market yesterday. Now, as you can see here, Asia suppliers follow Apple. Well, let's just quickly have a look at Apple. This is Apple's share price, and what I'm looking at here is year to date, just to give you some perspective. Now, the last bit we're looking at here is the dip since the release of the iPhone. And I was explaining to some of the trainees last week ahead of the actual Apple event how you get a kind of buy the rumor, sell the fact whenever Apple have an iPhone. There's a distinct pattern to the build-up and almost the euphoria they try to generate ahead of an iPhone release, where the market kind of buys into that idea, only to then the release comes out. It's completely as expected, no surprises whatsoever, and then the market starts to book some of the profit on the run-up that might have occurred in the weeks prior to the event itself taking place. The problem that Apple has had is that they've had issues with their iWatch, or the watch. They've had issues with the demand side is being particularly poor for the iPhone 8. Why? Because no one wants it. Everyone wants the iPhone 10, and that's not coming out until November. So basically, no one's pre-ordered an 8. And now what you're getting is the Asian component makers that contribute to the iPhone itself have started to decline quite sharply. Why? Because overnight there was reports that the company, Apple, had asked its suppliers to ship just 40% of their original planned quantities of components for the iPhone 10. So Apple themselves also, if the iPhone 10 disappoints, then you could probably expect then this price to come back, maybe even a little bit more, back to the mid-summer levels we were trading earlier this year, which would take us back down to the 145 area. We're trading around 150 at the close yesterday. Don't get me wrong though, is this the end of days for Apple? Certainly not. If you look at the year to date, Apple's up well in excess of 30%. Now this is the year to date chart I'm looking at here. So if you look at the 1st of Jan, we were trading a 116, 115. We're at 150. So yes, we've had a pretty sizable decline, and the reason why this is important, I'm talking about Apple specifically, is because it's such a large weighted stock for that index. So going forward, if you're playing off that divergence between the different US indices, then just be mindful of what Apple's share price are doing and monitoring the information pertaining to the iPhone 10 in particular. Okay, moving attention elsewhere, I want to have a quick update on the pound. Let's just have a quick look at the chart firstly to see where we reside, and then we'll talk about the fundamental factors behind what to look for going forward. And the 135 handle roughly has been a pretty good level. I mean, I think that goes back really, if I just look on my other chart, longer time frame to encapsulate the actual EU referendum itself. Stretch this chart out. So that was 130. I mean, this is a daily continuation, 137 at that high. But you can see that around 135 had been the post-EU referendum lows. If we continue higher, there's obviously a very important level coming up from the pre-referendum lows that we were at 138.35 ahead of 140. But quite phenomenal to see how much of this weakness that we had on the referendum we have taken back already. So going forward then, what are we to expect? I mean, looking at the pound at the moment, it's short term, it's found a decent area of support here around that 135, and this encapsulates a couple of things. This was the hawkish Bank of England fretting over the threat of inflation, and then this was the dovish MPC member Gertan Flager, who was a dove turning hawkish, surprised the market, and that's what contributed to that last little pop that we had back on, that was the 14th, followed by the 15th, Thursday and Friday of that week, and then we've kind of remained in that range from here forward. Going forward, Brexit talks recommenced with Europe following May's speech last week. How did that finish? Well, looking at the FT this morning, not particularly very well. Brussels rejects call for speedy talks on transition. If you remember, this is what Theresa May was really pushing, was securing this 2-year transitional deal so that then they can have some clarity about the near-term outlook and start discussing the more important trade talks. However, the EU has unexpectedly rejected May's demand for fast-track talks on a Brexit transition, prompting British negotiators to warn Brussels there are no excuses for blocking progress. So this is the opening of the 4th round of talks. This is something definitely we'll be keeping an eye on going forward. One of the key things here is that, well, it's this paragraph here. If we go further down, the article is saying, I don't think at this stage it will be possible to say that sufficient progress has been made, but it may well be possible by the end of October when we meet up in Brussels, he said after the meeting Theresa May in Downing Street. So October is really key, because if it's not done in October, then most of the belief is this will get pushed back out and towards the end of the year. And then obviously, you know, time is of the essence when it comes to the period of Article 50. An interesting thing, though, that's been occurring in the sterling market is, as we've just discussed, the pound remains elevated. Now, I just saw some interesting statistics from the CFTC this morning. So this is the measurement from the Commodities and Futures Trading Commission, the CFTC. And they basically, week to week, they'll monitor the speculative future contracts and positioning within the market, so we can ascertain how many contracts are long or short in different assets. Now, as you can imagine, if we start looking at some of these charts, let's have a look at this one here. You can see net short sterling positions back in if we start going back to Q1 into Q2 of this year, the market was at record amount of sterling shorts. So at the beginning of the year, if you were to ask most people in the market holding speculative positions what they think the prospect is for the pound, well, I remember a lot of the banks, I remember some big hedge funds calling for 120, 115, 110, and here we are, 137 almost at the high we printed at the end of last week. And so a lot of people getting that call wrong, the market not reacting as many would have believed about the political pressures building. That's not to say that this might start to seep into investor sentiment going forward, but the bigger thing here has been the resurgence of inflation. Remember the UK CPI moving back to 2.9%. This puts us back at the levels of May this year, but importantly back to levels not seen since the summer of 2013. This has meant then, this is why the Bank of England were hawkish, why the main dove on the MPC was hawkish, and we've seen here, this chart is the sterling positions on a weekly change. Look at the size of the swing to people now looking to go long sterling. In fact, if you're looking at it statistically, the change from the previous week was the largest positioning shift in favour of the pound on record, and the 4th largest weekly swing in either direction since the CFTC tracked data going all the way back to 1995. You know, so if you're trying to think of, well, what's people's view on the pound going forward, well, you can see those speculating that the pound's going to decrease in value going forward, the amount of people with that view is starting to diminish at a quicker and quicker rate. Now, some of the things that maybe to contemplate here are, at some point you would feel there is a sense of inevitability that the UK will secure a transitional deal. Because, why? Because they have to. There's no two ways about it. Whether Theresa May can manage that to safeguard her own future is another matter. But ultimately, a fee will need to be agreed and paid to get this deal done. And so at that point, when we have clarity from March 2019 and beyond, let's say for an additional 2 years, as being discussed, taking us through to 2021, does that provide then enough clarity for the bank or investors and consumers, more importantly, to feel more comfortable about the country's prospects over the medium to long term, and therefore the pound starts rising again? The one counter force, if you like, to cable continuing this resurgent move higher is the Fed and the dollar. If the Fed are to hike like that they're telling us in December, and to hike again 3 times in 2018, and to commence quantitative tightening with an incremental pace in 12 months' time, then you would be expecting dollar strength. So that could be your counteraction to this trade having at some point, a barrier to the upside. So again, timing is going to be key as to where this move in cable will go in the medium term. So a couple of things there, hopefully, to have a think about. Okay, just to wrap things up, let's have a quick look at the calendar. So this morning is relatively quiet. I wouldn't be expecting any movement in the pound on the back of the mortgage approval data. And actually, in fact, for the morning, things are very quiet. So taking us through into the US afternoon, Redbook and chain stores are non-events. These are just weekly readings from a retail perspective, but these aren't by any means important. These are I'd put down as third-tier data. Same case with Case-Shiller. Very rarely do people look at that for an opportunity to trade short-term. More interesting might be US consumer confidence. This has been tracking at relatively high levels, and looking at the analyst expectations, they are expecting a slight drop-off from the prior month, but nothing that would spook the market, I feel. And the housing data to be monitored, but again, much like the Richmond Fed Composite Index for services, not expecting a great deal from it. Actually, what's going to be more interesting today, and is definitely a prominent theme for this trading week, is speakers. So definitely be mindful, if you're going to be taking any trades, of the timings around when these central bank speakers are going to be hitting the news wires. The most important one, of course, Janet. Janet is speaking today. So Mrs. Yellen speaks on inflation, uncertainty, and monetary policy. That couldn't be more on topic in terms of the current environment as for what the Fed are monitoring. So if you want to stick around, well, it's going to be pretty late. The live guys, I'm sure you'll be trading this at 5:45. I'll find out nearer to the time whether or not there'll be prepared text. So that's it. I'm going to leave it at that. That's your brief. Any questions? I'll be here all day on the chat room, so just let me know. Happy to help. Otherwise, have a good trading day. Thank you very much.